What's up YouTube? So in today's video, I'm going to teach you guys about footprint terminology and how to read every single part of the footprint. So let's get into it. Now let's start out with the footprint in the most basic form, the bid and offer. So the left side would be considered the bid and the right side would be considered the offer, aka the ask. And we read footprints diagonally. So we would read it the 4 bid against the 101 ask, the 91 bid against the 107 ask, and the 98 bid against the 281 ask. Now the reason we do that is because in order to push prices up, the offer has to be raised. The offer has to be raised, and to push price down, the bid has to be lowered, the bid has to be lowered, the bid has to be lowered. And then the final part of the footprint right here is the point of control. Now what the point of control is where the most transactions are taking place on the candle. Now let's add in some imbalances. Now what imbalances are when the ask or bid is outweighing one another. So you can change these to different settings. I currently have mine set to 300%. Some people have theirs set to 400%. So you'll see that it will come in a bolded color, right? When it's the bid outweighing the ask, it would be a red bolded number. And when it's the ask outweighing the bid, it will be a blue bolded number. And you can see how when, the bolded red numbers start popping up, price tends to move down, and then as soon as the green candle forms with the ask starting to have some bolded numbers, meaning the buyers are outbalancing the sellers, we move up. So these boxes on the screen are what we call stacked imbalances, and what these are when there's multiple imbalances stacked one after the other, and there have to be 3 or more, and it will create this red box. And what this shows is that in this case sellers are very much outbalancing the buyers. And now you can use this as a resistance or support. As you can see, this was used as a resistance, and once we entered back into the stacked imbalance right here, there were more imbalances created where price further dropped. And now you can see that there are buy imbalances right here on this candle, and obviously there was no other confluence to take along after entered in, as sellers showed up rather than buyers. And then there will also be times where the stacked imbalance has 0 liquidity on the opposing side. Now this isn't really considered a stacked imbalance. What this is considered is trapped sellers. So these sellers are getting trapped, and people will usually trap them and send the markets back up. And you'll see in the previous clip, there was a buy side imbalance on the left, and there was 0 sell side liquidity on the left, meaning that buyers were buying the market higher with no sellings, and those people usually get trapped, and you saw that the market went down into a downtrend. And this is just the opposite case where sellers got trapped, 0 buy side liquidity, and market went into an uptrend. As you can see right here, here's another example where buyers got trapped once again, 0 sell side liquidity, and the market went back down into a downtrend. So the TDU footprint actually has a feature where it marks out these areas where sellers get trapped. You can see that sellers were trapped right here, 0 buy side liquidity, and they have a feature right here where it marks it out. But you can see that it extends all the way out, and I don't really like doing that, as I don't like taking plays based on future price action after this happens. I like taking it when it happens. So what I do is I just change it to bars, and I put the extend bar count to 1. So what it'll do, it'll just mark out where that happens on the chart, and I'll be able to see it. And if I see confluence for a long, in this case, I would have taken it up, and it will look like that. So another really awesome feature are value areas, and value areas will mark themselves out in the candle. You can see the green boxes, the red boxes, and what these are is where 70% of transactions take place on the candle. So kind of like the point of control, but instead of one single area where most of the transactions are taking place, it's where 70% of the transactions are taking place. Now there's many different strategies you can do with this. I actually have a whole different strategy where I use them in combination with Keltner channels, and it's super powerful. But if you were to use it just by itself with the footprint, you can look at where there are gaps in the candle, right? So we saw price come down, and there's this big gap, right? Consolidation, they're kind of touching each other, and then we see a huge gap down, and price continues to move down. Then we form a green candle. Now there's a huge gap up, and then we start to push up into this red candle, and then price consolidates. You can see the value areas touching one another, consolidation in the price, and then we finally have a gap between the two value areas, and then price continues to push up into this gap right here, but a red candle forms, right? And then after you see that red candle form, another gap, and price pushes down, pushes down, pushes down, and then we get into another consolidation where then the other gap is formed in the value area, and then price moves up. So they're very powerful. You can use them in combination with delta and volume and make a very solid strat. Now the next part of the footprint, which is such an awesome feature, is the delta divergence. Now you'll see a delta divergence when these dots appear. Now there'll be a different color when you add your footprint in. I changed mine for the positive delta divergence to be hot pink and the negative delta divergence to be blue. So you'll see the hot pink delta divergence show up when there's positive delta coming into the markets, but the candle closes red. What this signifies is that buyers are trying to push price up, but they were weak, and sellers came in and closed the candle red. This signifies weakness, and then you'll see the blue dot show up when there is negative delta in the markets, sellers trying to push price down, but buyers are stronger than them and close the candle green. Now you can see how we can use this in confluence when a stacked imbalance shows up and the candle closes with a positive delta divergence, meaning positive delta, but red candle showing strength in sellers, right? It almost showed up right at this level, and you could have taken it down for, if you entered at the candle close, you could have taken it down for 7.5 points. So I think this example here is actually amazing, right? You can see the first divergence show up right here, but this is a negative delta divergence, meaning that there was negative delta but a green candle. But we want to see that at a green line, not at red lines. We can see the positive delta divergence show up at the stacked imbalance right here, and you could have entered at the candle close once there was confirmation and taken it down for 8 points, right? And then there's positive delta divergence showing up right here. But why wouldn't you take these? Because there's no other confluence there. There's no stacked imbalance switching out all the way over here. There was one right here, but that already got broken, and plus there was zero buy side liquidity there, so that doesn't really count as a stacked imbalance, right? You know, maybe you could have taken this one since it was close to here. It was the first you know, kind of negative delta divergence popping up near these lines, and you could have taken it up, but you know, it didn't really touch this one. It was right at it. So now you can see how you can, you know, use the footprints, the different parts of the features of the footprint in confluence with one another in order to create a strategy, right? And here's like literally right after all this fiasco, we have the first one. It didn't really touch it, but then we had this one touch. Now you wouldn't enter on this candle, you would enter on the close of this candle once you see a positive delta divergence show up, red candle, green delta, and then you would enter right here, and you could have taken it down all the way down here for you know, technically you probably would have exited right here, but 11 points, right? You know, this one didn't touch, but it did touch this one, but you know, that kind of already touched there, so I probably wouldn't have taken this one, but this one was a perfect play. This one is a perfect play. This one I probably wouldn't have taken because it didn't touch, but those are just like beautiful plays that you can take every single time. So probably the most important part of the footprint are these numbers down here. Now this is the order flow, kind of telling you in-depth information on each candle, right? So we can see I have the volume set up first. That's just the volume in each candle. We have the delta, which is market buys and sells at each candle, right? It takes the whole entire bid, the whole entire ask, and it subtracts it from one another, and it gives you the delta. Then we have the maximum delta, the max delta that entered the markets. We have the minimum delta, the amount of negative delta that was in the markets, and then we have the cumulative delta, which shows all of the delta from every single candle throughout the day combined into one. And then we have the delta percentage, which shows you the delta divided by volume, and it gives you a percentage number. Now the most important part of this is the delta for me. You can see the aggression in sellers and buyers with this number alone, right? You can see that market was starting to increase in delta, 101, coming off a negative delta, 101, 386, kind of has some low delta here, but then we bump up to 600, right? And then we start decreasing from 245 to now negative territory again to 183. Then we get a huge extreme in delta, negative 800. And you can see what happens once that extreme comes in after the kind of stopping of increasing delta, and then we come all the way down, right? And then we continue to consolidate a bit. There was some negative delta coming in, some positive, mostly a consolidation, nothing serious. There was this volume that came in, which was a lot, but I'm on the range chart, and the reason this volume was so much was because this candle just took a while to form, so there was a lot of volume that kind of came in. But we don't see anything major in the delta. We start seeing some increases right here, but this was coming off a decrease from 378, 578, 722, and then we start to see a huge increase, right, until we get right here. This can be considered a market shift. The delta didn't get marked out because it wasn't at 750 yet, but you can see the 11K volume, almost 750 positive delta with very minimum negative delta, right? But if you didn't want to consider that, you didn't want to go into a long right there, you could have waited until you saw this, right? Now this is a absolute confirmation of a market shift, of the market going to an uptrend, when we have positive 765 delta kind of coming in at the lows with one negative delta, right? And you can see what happened after that, a huge uptrend. Right, here's another example of that. Okay, so we have 786 positive delta with a candle percentage of 22% with no negative delta coming into the markets. But how would you know not to take a long right here? Well, for one, you really don't want to take a long after a super strong uptrend like that. You kind of want to see these deltas coming in off of lows, not off of highs. Now, when we look at the top of the candle, we can see that there was so much buy side liquidity, but there was zero sell side liquidity. Now you can see what happens, right? It happened in this candle as well. These buyers got trapped, and then we see a huge negative delta entering at the highs, not the lows, the highs. Now that's a really good confirmation to take a short, and you can see what happened. So the next part of the footprint that I want to show are these delta signals right here. Now delta surge is the only one that I really pay attention to, as the other ones I don't find as powerful, and delta surge tends to show up multiple times a day, and you can really use it in confluence with your trading. Now to explain what it is, I'm actually just going to pull up the website because it's a super powerful tool, and I want to give you the best explanation possible. So the delta surge is a 4-bar signal, and it's indicated with the letter S or a magenta stripe, and this happens when there's a sudden increase in delta, when the delta is getting stronger and stronger, and it shows that buyers are controlled. Some indices, obviously sellers, if the delta is decreasing. And so in order for it to pop up, the first bar has to have a negative delta, and the next bar has to have a positive delta, and the following two positive bars have to increase in the delta, right? And then vice versa, obviously. So let's explain what we see here. All right, the first bar, the positive delta, and then the next two bars increasing negative delta, with the final bar being negative 900, and we saw that the market downtrended a bit, right? And then another one popped up, first bar negative, next two bars, two positive with increasing delta, and then the final one, a huge increase in delta, and we saw the market uptrend, right? And this was just a fiasco of fast movement. I think this was FOMC. I'm just using all recent data pretty much. I didn't really cherry pick. I'm just kind of using data from the previous days, but this is a very powerful tool that you can use in confluence with delta divergences or volume or whatever the case may be. You can figure out a strat with it, and it's very powerful. So the final part of the footprint that I want to go over is these POC buys and sells. Now in order for these POC buys and sells to form, as you can see, they are triangles. The open of the candle and close of the candle has to close below the POC line. In order for it to be a buy signal, the open of the candle and close of the candle has to be above the POC line, right? And you can see how you can use them in confluence. Just like the delta divergences, you can look for them at the stacked imbalances. You can see that you could have taken markets down as these shown up at this stacked imbalance, right? With this POC buy signal, you can see that there was huge sellers trapped. 730 contracts being traded at the bottom right here with zero sell side liquidity, someone going way below the bid, and you can see that they got trapped, right? And that could have been a buy signal if that's your trading strategy. But honestly, I like this one where there's stacked imbalances and you see the the POC sell signal or the delta divergence, which can be very powerful, right? And a lot of the times you'll see them show up with the delta divergence. That can just give you more confluence to take like a stacked imbalance trade, right? You wouldn't take the sell, you wouldn't start shorting right here on this candle close because there's no confirmation of this level going to work out. What's your confirmation? Your confirmation is this candle closing red with the delta divergence, with the POC sell signal, and you could enter in at the candle close. You would have taken about 3 points drawdown, but then you could have taken 8 points, about 8 points of profit. So if you guys learned something from this video, please be sure to leave a like and subscribe, and make sure to watch my previous video on how to practice these footprints, because you really want to go into market replay and practice them to understand what your best strategy would be to fit you the best, and you can really understand how to use all these features in confluence with one another, and that'll really help you in live data. So I hope you guys enjoyed the video, and I'll see you in the next one.